Welcome to the KRP Connection podcast with your host, Karla Parker. Whether you're a first-time buyer, seasoned investor, or just curious about the world of real estate, this podcast is for you. Look no further as Karla navigates the complex world of real estate. So tune in and join us on this journey to unlock the secrets of real estate success.
So we are going to talk a little bit about the power of the Black dollar. And I cited a CNBC article or a Squawk Box that says the Black spending power has reached 1.6 trillion. However, our net worth has fallen. And in that, we know that African-American women tend to be heads of household. So speak to at a high level to this 1.6 trillion and how it shows up in housing.
So when you say how it shows up in housing, are you referring to the percentage in which we are buying?
Sure. And is that spending power translating into, this area of quote unquote spending?
It is. I would say that right now, I believe that the African-American home buying ratio is at 43%, which is less than, our white counterparts, right? That's more like in the 70s, and the Hispanic community is more like 50%. So we're obviously consumers, unfortunately. It's a known fact that the African-American community spends lots of money, but we're not necessarily recycling dollars within our community, and we're also not putting those dollars into investments like homeownership at the same pace as, other segments are.
Okay. And so when you're approached in this market, we're in the San Francisco Bay Area, it's early 2023. What are you seeing in terms of the landscape of African-American homeownership specifically in this market?
I don't know that I have necessarily a percentage, off the top of my head of African-Americans in the Bay Area specifically, right? I just have more of the national numbers in terms of the homeownership piece, but it's certainly, we're behind.
Okay.
From a homeownership perspective, we've been behind since probably the 60s. I mean, in the 60s, I want to say that our homeownership rate was much higher than it currently is. And a lot of that, I think, is contributed to, we have such a consumer mentality. And so we're buying all these things, but we're not buying the things that's going to help us build wealth. We're buying cars, and watches and
tennis shoes, right? Sneakers, right?
Exactly. And this is in general. Obviously, there's a population of Black folks who are investing their money wisely and so forth. But in general, as a community, we're not invested in the way that we need to be. It's certainly not in comparison to our white counterpart.
Okay. And so we established that we're a $1.6 trillion piece of the American economy. And we know that women make less than men, and then Black women make less than other women. So when it comes to housing, let's do a little bit of math. And in general, what's the percentage of one's monthly income that can or should be attributed to housing?
So, it depends. That's a very good question. And as you may recall in your loan officer days, right, where you've got various investors out there who dictate how lenders are going to be able to approve buyers.
Right.
And so if we're talking about Fannie Mae or Freddie Mac, which are the two kind of largest investors in the market, they typically want your ratios to be no more than 36% of your gross monthly income. Like that ratio is the maximum that they want you to be spending, on your total principal, interest, taxes, and insurance. And then the other kind of ratio, and we refer to it as debt to income ratio. The other is, well, how much does your principal, interest, taxes, and insurance, PITI, how much is that plus any consumer debt you have, like car payments, student loans, credit cards? All of that combined shouldn't be more than 45% of your gross monthly income. And if it is, you are exceeding kind of like the guideline, but there are some circumstances by which you can go up to 50, that's 50%, but there's all kinds of exceptions and such.
Okay. So I just want to break that down into palatable. Yeah, exactly. So let's just say in, a fantasy world, we make $100 a month, just so that the numbers are easy. We make $100 a month. Fannie and Freddie are saying that our housing allotment, meaning our principal payment on our mortgage, our interest, our taxes, and our insurance have to be no more than.
Well, if 36% of that would be $36.
Exactly. Okay. And so then if, let's just say, our car payment, everything else, our food, all of that, the maximum expenditure per month, just for the understanding of the ratio, would be 45 of those $100, correct?
Correct.
Okay. So that's what ratios mean. And I think a lot of people, it's kind of like an insider secret as to what we're talking about when we're talking about ratios. And sometimes people are at the lending table when they start to hear these numbers for the first time. And so this loops us back into spending. If we go out and we buy that car and the payment is $700 a month, then our ratios might end up being off. So we need to be mindful of that when we're out there spending, especially for things that are, long-term investments or commitments in terms of payments. And so,
including, can I just add this, Karla?
Sure.
Including car leases. Sometimes people don't realize that a car lease will still impact your ability, to qualify, right? Because they think, oh, my car lease is going to be up in 2 years. So, well, it doesn't matter. You can't just turn it back in. In most cases.
Oh, you have to go to the end of the lease. It's for 2 years. Yeah, exactly.
Exactly. So that is something that kind of crops up at times with car leases.
Yeah. And then at the end, I'm not bashing anybody's choices, but, at the end, you kind of got to start over or, come up with a significant amount of cash to replace that vehicle. So that's one that should definitely be thought out in advance. So we know that African-American women are educated, highly educated, probably one of the highest groups in America to pursue higher education. And so there's probably, there is a cost associated with that and to access that opportunity. And so how do student loans end up playing into the debt to income ratio?
Well, similar to car payments, the lease payment we were just referring to, student loans are also a factor. So, if you have a student loan that you've had for 1 year, 10 years, 20 years, some people have student loans that are still on the books,
right?
Unfortunately. It used to be, some years ago, decades ago, that the student loans, if it were deferred for 1 year or more, the underwriting guideline was set up such that you did not have to include it in their qualifying ratios. However, that has changed many times over the past 30 years, right? And now today, the guideline requires that, if the payment itself is represented on the credit report. So if you run a credit report and there's a student loan and it actually shows a payment, the guidelines allow the lenders to use that payment. But in a lot of cases, there is no payment there. It just shows nothing in the payment and it shows, a $50,000 balance, right?
Right.
In that case, depending on who the investor is, so we talked about Fannie Mae and Freddie Mac earlier, depending on who the investor is will determine the percentage of that $50,000 you have to use to create,
a payment,
a monthly payment.
Got
so
it.
The range is anywhere from 0.5% to 1%. So
of what is owed?
Exactly. So that would be a $500 payment if we're talking about 1% of the $50,000, right?
Okay.
So between $250 and $500 would be the monthly payment attributed to the debt to income ratio if we're talking about a $50,000 student loan.
Mm-hmm.
And currently there is no way to get around it. It certainly has been something that folks have lobbied about, just trying to help a lot of folks because African American folks are disproportionately impacted by student loans because we, as a culture, we don't have, Big Mama writing
those checks,
$500,000 checks for you to go to college, or we don't have a trust fund.
Right.
So we do get student loans, and a lot of times that is one of the reasons why we are not able to buy in, the numbers that our white counterparts are able to.
Gotcha. So it ends up becoming part of the debt to income ratio, but it's a leg up towards being able to make more, but it does have to be factored in when thinking about purchasing a home, because it is there, whether it's a phantom payment or not, it does show up. And so we do have to factor that in. Talk about a little bit about how rates are incorporated into the mortgage loan process.
So, the interest rates, depending on, what's going on in the market, they're used to calculate the principal and interest repayment portion of the overall payment. And so depending on, where interest rates are, you may be in a situation where you are always exceeding the debt to income ratio, because now instead of rates being at 2.5% for a 30-year mortgage, rates are closer to 6.5%, 7%, depending on, your credit score and all these other factors. And so that really does impact the whole mortgage loan process in general. Like if we were at a 0% interest, everybody would be in this
right.
But, when the interest rates start to tick up, it starts to kind of shut out populations of people, right? Because your income is directly associated with what you're able to buy.
Right.
And if interest rates are 1 and 2 and 3 and 4% higher than what it had been, then that's going to essentially lower what you can buy. So last year, a borrower or couple, whatever, they may have been able to qualify for $1 million purchase, right? And today, that same couple with that same income and that same debt may now only qualify for 600, maybe.
Okay.
Because of the dramatic,
cost of money. Yeah.
Exactly. The cost of money. It's up there.
Yeah.
It's still worth it though, right?
Right.
It's always a good, strategy. The question is, what do you have to give up in order to gain that, right? And sometimes I've had clients over the years, I said, sell that car, get rid of it, sell it, and you'd be able to buy more house,
right?
Or pay off your credit cards or refinance your student loans.
Right.
There's so many things. Refinance your car loan. I've had clients who had 3 years left on a car, refinance it to a 7-year.
Oh, there you go. Get that payment down. Yeah.
Get it down, because it's all about the monthly payment, right?
Right.
That's what it's about.
Right. And then are you seeing buy downs, sellers contributing by helping to buy down rates?
Absolutely. It's like deja vu. It's like in the 80s, late 80s and
like
90s.
We're starting over again.
We're starting all over. Yes, absolutely. The 2
right.
buy downs are making a
comeback.
Right?
Like the platform shoes.
Right? And sellers are not, they're not oblivious to what is going on. They may kick and scream about the price they want. They may kick and scream about not wanting to give up, their dollars. But at the end of the day, if you can sell the house, but it requires you to give a little help to the buyer, by way of, some kind of closing cost credit through this 2-1 buy down, then you're going to do it, especially if you have to sell. You have plenty of sellers that don't necessarily have to sell, and those type of sellers are not going to sell. Right.
They can wait till the next uptick in the market.
Exactly.
Yeah. And so that's when you get a good agent, those are the tips and tricks that you can hear about, learn about.
Right on. Great realtor. You're the one.
I definitely try. And I do believe that because I was a loan officer, like I understand how to help in ways that perhaps other realtors, don't.
And I would agree, Karla, because as you may recall, I started in the business at 19 as a real estate agent.
Oh, wow. Flip-flop.
So I can say definitively 30 some odd years later that, a realtor who has had, experience from a mortgage perspective, understanding the guidelines, how the underwriters kind of think and process, what the appraisers are looking for. It really does make a difference. Not to take anything away from realtors who have not enjoyed that robust experience on both sides, but it really does make a very big difference just in terms of, a realtor's understanding of the process and maybe how they can, kind of coach their clients, because for whatever reason, even though we, the loan officer, we're the ones with the money.
Right.
But for whatever reason, these buyers want to run over here to the shiny new toy, which is the realtor, because
right.
the realtor's got the house. They've got all these beautiful homes they're showing.
Right.
And invariably, buyers will run over there talking to realtors, getting all excited about what they cannot buy, right? Because they have not had an opportunity to get
done their homework.
Qualified.
Yeah.
Good Lord.
Yeah.
Listen.
Yeah.
So yeah, I think it's great you've had that experience, and you're an awesome resource as a realtor.
For sure. And it's not always easy to take that first step into the realm of what can I afford? And this is going to lead into my next question, but ironically, I got an email yesterday. I'm going to get all choked up from somebody who I referred to and one of the programs that we're going to talk about in a minute, maybe 3 years ago. And she told me yesterday that she's been pre-qualified. I'm like, whoa, my babies.
Oh, wow.
I love it. And I'm patient. I'm willing to stay the course and wait for people to do the right thing, because as we have learned, the mortgage, the instrument, the paper is sometimes more important than the house. And I cannot say and stress that enough, because all loans are not equal.
Sure.
Got to get the one that's right for you. So in terms of African-American women, I have an answer to this, but I want to hear your answer. Do you see African-American women tending to buy with partners or on their own?
In the amount of time, I've been in business over 30 some odd years, and I would say, just using my own client base
as
a statistic,
right.
Back in the early 2000s, I would say that the majority of my clients were female, and the ones that were African American, which I'm going to say probably represented 50% of my client base, more times than not, they were buying by themselves.
Yeah.
They did not have a partner.
Right.
And it actually seems to be similar for other
right.
other women, right?
Right.
And so there's statistics that suggest that women obviously buy at larger, higher percentages than men do. They're always the one that really inspires
right.
the idea around homeownership. Right. And I think because we all have this leave it to Beaver mentality.
Right. We're nesters. Yeah, exactly.
Right? Yeah, we're nesters, and we gonna get married, and we're gonna have some kids, and we want to have a house, and we don't just want to have a house, we want to buy the house.
Right.
And a lot of times it's women that are inspiring that. So, hey, let's standing ode to women
right.
for inspiring, their partners, right?
Right.
To do things like buy homes. I think it's great.
Yeah, it's awesome. It's a really good feeling. And yeah, I've had that experience too, where by hook or by crook, she got $2 left in the bank when it's all said and done, but she's done it, and I just stand up and cheer. I'm so proud when we're able to make that happen. And so when you look at the files of African Americans in general, where do you feel like there's the biggest bottleneck? Where do these files tend to get stuck? Yeah, I mean, there are a lot of places, but I would say that statistically, it's at the debt to income. Okay. Roadblock, right? There's a roadblock with the debt to income ratio because in general, we're always carrying more debt than, our white counterparts. Because it goes back to how much most of us don't have a trust fund. Or how much we make by comparison. We make less, but things cost the same. And so, yeah, okay. And that too, but even when you take, an African-American couple who makes the same amount as this white couple, more times than not, the Black couple has more debt, and they have more debt a lot of times because they have student loans and they're also buying cars. It's culturally, we're just different. We are MTV Live. We gotta have all the way, the spinning, the ring, bringing the bling. We bringing the bling, and so it's like the white culture is very different from that perspective, right? They certainly appreciate more of, this investment and keeping, their debt down and paying credit cards off as they use them as opposed to what, a lot of, African-American folks do. We keep it about to the max. To the max. To the max. I got $5 left on my $10,000 limit. Exactly. Okay. So that spending, that expenditure. And, one of the things that I end up having to coach buyers, especially first-time buyers on, especially in the Bay Area. Maybe this isn't true in other parts of the country, but when you come to the Bay Area and you try to buy a house, your first house will probably not be your last. And so the idea of building equity within that house and not trying to go all out the first time is something that I really spend a lot of time massaging the reins back in on and saying, let's just start somewhere. Let's just get it cracking. And
I think it's important, that people understand statistically the house you buy today, in your 30s is not likely to be the house that you retire.
Right. Right.
So from that perspective, it's just like your first car at 16 was a hoopty. Right. And now, you're driving, a 5 Series or whatever the case may be, right? A Mercedes.
Because you worked your way up. Yeah.
Because you worked your way up. And so home ownership should be kind of viewed in that same way. Get yourself a hoopty. Right. Build some equity, in that hoopty.
Exactly.
And then, like, in a couple of years,
trade
I had a
up.
client in 2020, Karla. I had a client who, I don't even think she was 30. She bought a hoopty for sure in Richmond, California.
Okay.
And 2020, the end of 2021, she sold that little place, that little Cracker Jack's place, for $60,000 more than she paid now. In a year and change, she would not have been able to save that kind of money. She made good money, but she didn't make enough money to save $60,000 in a year and a half. You know what I mean?
And so
even from that perspective,
right?
$60,000 is still $60,000.
Amen. Yeah. And it's it that appreciation. I mean, and this depends on the market that you're in, but are your earnings outpacing appreciation? In the Bay Area, the appreciation traditionally has just been astronomical, and it's the new California gold. So getting people to understand that and getting them to participate is the biggest challenge for me, but it's so beneficial when it happens. And so to that point, savings can definitely be tough. I worked at a nonprofit in San Francisco, and I was teaching a first-time homebuyer class. I was still doing lending, and I was asking this client, I said, okay, so what have you got in savings? And she said, what savings? I live in the Bay Area. And, it's probably like 15 years ago, and I'm still talking about that. And because that's
a pain
point. Exactly. And these programs do help in some ways, but they're not the be all. And so what's an ideal amount of cash or savings that you want to have available, liquid? And can retirement funds be attributed to, what's in, quote unquote, in the bank?
That's a really good question, Karla, because, of course, money makes the world go round. Mm-hmm. And, your savings, your mattress money, all of that is money that you may need to use to purchase your home with your down payment and closing costs. So in general, like we talked about earlier with investors, it really does depend, right? So depending on who the investor is, you may be required to verify like your funds for down payment and closing costs and 2 months PITI, that principal interest tax, that total monthly payment. And so if you can verify, your down payment, let's say it's, $10,000 plus your closing costs, let's say it's $5,000, right? So we're up to $15,000.
Okay.
And then you need to be able to verify, your 2 months payment. And let's say that's, $1,000. So that's $2,000 in monthly payment. So you're looking at $17,000, and I'm just using, let's say, $100,000 purchase price. Mm-hmm. So you need to be able to verify that. And those monies need to be monies that were actually sitting in a bank for at least, the guideline says 2 months. I like to say 3 months.
Okay.
Only because if you turn in a bank statement from January and it shows information from the last week of December and you just made a deposit, it's like, where did that $10,000 come from?
Oh, surprise. Yeah, exactly.
Yeah, we don't want to have to answer any questions about large deposits. And large deposits are deposits that represent, more than what your net income is being deposited, right? So a $10,000 or $20,000 deposit is nothing if, you make $100,000 a month. But the point is, most of the guidelines require that you have seasoned funds, which is generally 2 months. 2 months in the bank, in an investment, stocks, bonds, in a retirement, right? Your 401k certainly counts.
Okay.
But there are some programs, mostly like jumbo products, jumbo loans that are above the conforming loan limit. Those programs may require that the borrower have anywhere from 6 to 24 months in reserves. So they have to have 6 to 24 months of their monthly payment in some account. And generally, they will not allow you to use the 401k.
Retirement funds. Okay. The
retirement funds, which is unfortunate. But some, there are some lenders who will, and then some who will say, well, if you liquidate it, right? So pull it out of the 401k and now put it into some other vehicle, like a mutual fund or, a money market or whatever the case may be. But in general, it all depends on who the investor is. And so it's really important when buyers are kind of beginning their process, depending on where they are, to ask the question, what kind of reserves am I going to be looking, right? Because the answer is going to be different.
Depending on the investor, depending on where the loan is being sold to. Got you.
Exactly.
Okay.
And price point. If you're buying a $200,000 house, very different risk factor than someone buying, a $2 million house.
Right.
Yeah.
Very good.
Thanks for tuning in to the KRP Connection, where we explore the trends and insights in the world of real estate. Don't forget to follow and subscribe to our podcast for future episodes. Also, share with your friends and family. And lastly, for more helpful insights and resources, make sure to visit karla.realestate. See you next time.